Have you ever felt like the economic news is playing a confusing game of good cop, bad cop? One day, headlines trumpet robust job growth, suggesting a thriving economy. The next, consumer confidence plummets, hinting at underlying fragility. This apparent contradiction isn't a flaw in the data itself, but rather a fundamental characteristic of how we measure and understand a dynamic, multifaceted economic system. The economy is not a monolithic entity, nor does it speak with one voice. Instead, it's a vast, intricate web of interconnected yet distinct components, each moving at its own pace and responding to different stimuli. When we encounter conflicting economic reports, it's often because we're trying to force a complex reality into a simplistic narrative. This video will equip you with the analytical framework to decipher these mixed signals, transforming confusion into clarity. This video is designed to help you understand why economic data often sends mixed signals, even when the data itself is accurate and responsibly reported. By the end of this video, you will understand why different economic indicators measure different realities, why timing plays a larger role than most people realize, and how to read conflicting data without assuming something is broken or misleading. This video is not about predicting the future. It is not about reacting to headlines. And it is not about telling you what decisions to make. It is about helping you interpret economic information more calmly and clearly. One primary reason economic data feels confusing is that it's often treated as if it answers one overarching question about the economy's health. In reality, each indicator is meticulously designed to capture a very specific aspect, addressing distinct questions. For instance, the Consumer Price Index, CPI, measures changes in the cost of a basket of goods and services, directly addressing the question of inflation. Conversely, Gross Domestic Product, GDP, quantifies the total value of goods and services produced, answering questions about overall economic output and growth. Employment figures, such as the unemployment rate or non-farm payrolls, focus solely on the labor market's health and dynamism. Each of these metrics provides a crucial piece of the economic puzzle, but none offers the complete picture in isolation. Confusion arises when we expect all these disparate indicators to point in the exact same direction simultaneously. An increase in GDP doesn't automatically mean inflation is under control, nor does a low unemployment rate guarantee robust consumer spending. Investors, students, and the general public must recognize that these are distinct lenses through which to view different facets of economic activity. The economy is not one machine moving at one speed. It is a collection of diverse, semi-autonomous systems. These include households, businesses, financial markets, and governments, each with its own motivations, constraints, and response times. Each of these sectors responds to economic changes differently, creating a dynamic and often asynchronous movement across the broader economy. During periods of relative stability, these inherent differences in behavior and reaction times are often easy to overlook, as most sectors tend to move in a broadly similar direction. However, during economic transitions, whether entering a recession, recovering from one, or navigating periods of high inflation, these differences become starkly visible. For example, businesses might delay investment decisions even as consumers continue spending, or financial markets might react swiftly to anticipated policy changes while the real economy adjusts much more slowly. Economic data reflects this uneven movement, capturing the distinct rhythms of each sector. Understanding this disaggregated nature of the economy is crucial for investors seeking to identify opportunities or risks, for students learning economic models, and for policymakers crafting targeted interventions. It highlights why a single data point can never fully encapsulate the state of the entire economic landscape. One of the most important distinctions in economics, and a frequent source of public misunderstanding, is the difference between levels and rates of change. This concept is particularly salient when discussing inflation. Inflation data, such as the monthly CPI report, primarily measures the rate at which prices are rising or falling over a specific period, typically year over year or month over month. However, people experience the level of prices, how high prices already are for everyday goods and services. If the rate of inflation slows from, say, 9% to 3%, the data indicates an improvement, prices are still rising, but at a much slower pace. Yet, the cumulative effect of past price increases means that the overall cost of living remains significantly higher than it was before the inflationary surge. Both perspectives are entirely correct, but they are measuring fundamentally different things. The economist or investor might focus on the decelerating rate as a positive sign for future policy or market direction, while the average consumer continues to feel the pinch of elevated prices at the grocery store or gas pump. This divergence between statistical improvement and lived experience often fuels frustration, but it does not invalidate the data. It simply highlights the importance of understanding what each metric truly represents. Most economic data is inherently backward-looking. It summarizes what has already happened, often with a significant time lag due to collection and processing. This means that by the time a report is released, the underlying economic conditions it describes may have already shifted. In contrast, financial markets tend to be forward-looking, attempting to discount future events and expectations into current asset prices. People, on the other hand, live and react in the present, experiencing current conditions and forming expectations based on immediate observations. This creates a crucial timing gap between reported data, market sentiment, and real-world experience. During calm, stable periods, this gap is barely noticeable, as economic trends are generally consistent. However, during periods of rapid transition or uncertainty, this timing gap becomes glaringly obvious and a significant source of confusion. Data isn't wrong in these scenarios, it's simply late. For investors, understanding this lag is critical for avoiding reactive decisions based on stale information. For students and the general public, it explains why official reports might seem out of sync with their daily observations or market movements, underscoring the dynamic nature of economic information. To navigate the timing complexities of economic data, economists categorize indicators into three distinct types: leading, coincident, and lagging. Each category serves a different analytical purpose, providing unique insights into the economy's past, present, and potential future trajectory. Problems arise when these indicators are treated as interchangeable, leading to misinterpretations of economic trends. Leading indicators, such as new building permits or consumer confidence indices, typically change before the broader economy begins to follow a particular trend. They are crucial for forecasting future economic activity and are closely watched by investors seeking to anticipate market shifts. Coincident indicators, like industrial production or personal income, move roughly in tandem with the overall economy, providing a real-time snapshot of current conditions. Lagging indicators, such as the unemployment rate or corporate profits, change only after the economy has already begun to move in a certain direction. They confirm existing trends and are valuable for understanding the duration and severity of economic cycles. Understanding this distinction is essential for anyone attempting to make sense of economic news, as it provides a framework for interpreting seemingly contradictory signals and building a more comprehensive view of economic momentum. Employment data, particularly the unemployment rate and non-farm payrolls, is among the most closely watched and yet frequently misunderstood economic indicators. This is largely due to the inherently lagging nature of labor markets. Businesses are typically slow to adjust their workforce in response to changing economic conditions. They often exhaust other options, such as reducing hours or freezing hiring, before resorting to widespread layoffs when conditions weaken. Conversely, during an economic recovery, businesses are cautious about rehiring, often waiting for sustained improvements in demand before expanding their payrolls. This means that employment figures can often appear robust even as other parts of the economy are showing signs of weakening, or conversely, they may remain elevated long after a recovery has begun. For example, the unemployment rate might continue to fall even as GDP growth decelerates, creating a perception of strength that doesn't fully reflect the broader economic picture. This is not a contradiction in the data itself, but rather a reflection of the typical sequencing of economic cycles. Labor markets adjust slowly, making employment data a lagging indicator that confirms trends rather than predicting them. Investors must be aware of this lag to avoid misinterpreting strong job numbers as a definitive sign of future economic health. especially during periods of transition. Inflation statistics, while meticulously calculated, are inherently averages and therefore cannot capture the full spectrum of individual economic experiences. The Consumer Price Index, CPI, for instance, measures the average change in prices paid by urban consumers for a basket of goods and services. However, this average can mask significant variations across different regions, demographics, and household spending patterns. For example, a national inflation rate might show a modest increase, but if energy and food prices, which constitute a larger portion of lower-income households' budgets, have surged, their personal experience of inflation will be far more severe. Similarly, some prices might fall, e.g., electronics, while others remain stubbornly elevated, e.g., housing, healthcare, and still others rise again, e.g., services. The aggregate data describes the overall movement, but not the personal reality of every consumer. This difference between the statistical average and individual experience fuels widespread frustration and often leads people to feel that inflation data is misleading. However, it does not invalidate the data's utility for policymakers and economists who need a broad measure of price stability. Understanding these limitations helps investors and the general public interpret inflation reports with appropriate nuance, recognizing that their personal cost of living may diverge from the headline figures. Economic data is frequently subject to revisions, a practice that can feel unsettling to the uninitiated, suggesting a lack of accuracy in initial reports. However, these revisions are not a sign of deception or error. Rather, they are an integral and necessary feature of robust economic measurement. Early estimates prioritize timeliness, providing policymakers, businesses, and markets with immediate, albeit preliminary, information. These initial releases are often based on incomplete survey responses or preliminary data collection. As more comprehensive information becomes available, for instance, additional survey returns, updated administrative records, or more detailed seasonal adjustments, statistical agencies revise their estimates to reflect a more accurate picture. Later revisions prioritize accuracy, ensuring that the final data provides the most reliable historical record possible. This trade-off between speed and precision is unavoidable in complex economic systems. Revisions are a feature, not a flaw, of the data collection process. For investors, understanding that initial reports are often subject to change encourages a cautious approach, avoiding knee-jerk reactions to preliminary figures. For students and economists, it highlights the dynamic nature of economic statistics and the continuous effort to refine our understanding of economic reality. Despite the inherent complexity and nuanced nature of economic data, there remains a strong societal preference for clear, confident narratives. Human psychology often seeks simplicity and certainty, especially when faced with intricate information. This preference is amplified by media incentives, which often reward definitive statements and dramatic headlines over nuanced explanations. As a result, the rich detail and inherent contradictions within economic data are frequently reduced to simplistic, good or bad stories. Nuance is often stripped away, and conflicting data points are forced into a single, easy-to-digest narrative, even if it oversimplifies or distorts reality. This tendency, while understandable, ultimately increases confusion rather than reducing it, as people struggle to reconcile the simplified story with their own observations or subsequent conflicting reports. Understanding this dynamic helps investors, students, and the general public remain grounded. It encourages a critical approach to economic news, prompting deeper inquiry beyond the headlines. Recognizing that media often prioritizes clarity and impact over comprehensive analytical depth is crucial for developing a more sophisticated and resilient understanding of economic trends. Instead of asking the overly simplistic question, "Is this good or bad for the economy?" a more useful and analytically robust approach is to ask, "What specific part of the economy does this data measure, and what is its typical timing in the economic cycle?" This reframes economic data from being a definitive verdict into providing valuable context. By adopting this perspective, you begin to see each economic report as a snapshot, a single piece of a much larger, constantly evolving puzzle, rather than a final judgment. For example, a strong retail sales report, coincident indicator for consumer spending, might be viewed alongside a rising inventory-to-sales ratio, a leading indicator for future production cuts. This allows for a more holistic and less emotionally reactive interpretation of economic conditions. This analytical framework encourages a deeper understanding of economic interdependencies and the typical sequencing of economic events. It empowers investors to make more informed decisions by considering multiple perspectives, helps students build a robust understanding of economic dynamics, and enables the general public to navigate economic news with greater clarity and less anxiety. This episode has laid the foundational understanding of why economic data often appears contradictory, emphasizing the distinct questions each indicator answers, the disaggregated nature of the economy, and the critical role of timing. We've explored the difference between levels and rates of change and introduced the categories of leading, coincident, and lagging indicators. In the next episode, we will delve deeper into the practical application of these concepts, focusing specifically on leading versus lagging indicators. We will explain in detail how these timing differences shape perception and influence decision-making for investors, policymakers, and consumers alike. Each episode in this series is designed to build upon the last, progressively enhancing your economic literacy and analytical capabilities. You now understand that mixed economic signals are not anomalies, but rather inherent characteristics of a complex, dynamic system. They reflect different measurements of distinct economic facets, occur because various economic systems adjust at different speeds, and are particularly normal during periods of significant change or transition. Confusion, therefore, is not evidence of a failure in the data or your understanding. It is often a sign that a significant economic transition is underway. With this analytical framework, economic information becomes easier to interpret, less prone to misinterpretation, and significantly less emotionally reactive. Please like this video if you have enjoyed it or received any benefit from it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.